Before we begin, a quick and important disclaimer. I am not a licensed financial advisor, and this presentation is for informational and educational purposes only. The information provided in this video does not constitute financial, legal, or tax advice. The mortgage landscape is complex and highly personal. You should always consult with a qualified and licensed professional, like a financial advisor or a mortgage broker, before making any decisions based on the content of this video. Your financial situation is unique, and the choices you make should be tailored to your specific circumstances and goals. Imagine it's 2006. A young couple, let's call them Mark and Jessica, are buying their first home. They're ecstatic. They walk into a lender's office, and they're presented with a miracle product, an adjustable rate mortgage. The interest rate is an astonishing 2%. It's a full 3 points lower than any fixed-rate loan they've seen. Their monthly payment is so low, they can afford a bigger house in a better school district. They feel like they've cracked the code. They sign the papers, convinced they are the smartest people in the room. For the first 2 years, everything is perfect. They're living the American dream. And then it happens. The teaser rate expires. The global economy shudders. Their interest rate doesn't just nudge up. It skyrockets from 2% to 7%, then 8%, then 9%. Their monthly payment doubles. Suddenly, the dream home is a nightmare. They're drowning. Within a year, the foreclosure notice is on their door. This story, or a version of it, played out millions of times across America, and it burned a permanent scar into our collective psyche. It's the reason the term adjustable rate mortgage makes most people flinch. It became synonymous with risk, with gambling, with the catastrophic financial collapse of 2008. For over a decade, the fixed-rate mortgage has been crowned the undisputed, heavyweight champion of home loans. It's safe. It's predictable. It's boring in a good way. Over 90% of homebuyers today choose a fixed-rate loan without a second thought. But what if I told you that for a huge number of those people, that was the wrong choice? What if that safe choice is quietly costing them tens, or even hundreds of thousands of dollars over the life of their loan? What if the very thing that caused the 2008 crisis has changed so dramatically that it might now be one of the smartest financial tools available to a modern homebuyer? That is the entire point of this video. We are going to rip apart every myth, every fear, and every piece of outdated advice you've ever heard about mortgages. By the time you're done watching, you will not have a one-size-fits-all answer. Instead, you will have something far more valuable. A powerful framework to analyze your own life, your own finances, and your own tolerance for risk, so you can decide for yourself which of these powerful financial weapons is right for you. This isn't just about picking a loan. It's about architecting the next 30 years of your financial life. So let's start with the reigning champion, the fan favorite, the 30-year fixed-rate mortgage. The concept is beautifully simple. You borrow a large sum of money to buy a house, and you agree to pay it back over 30 years. The fixed part is the magic ingredient. The interest rate you lock in on day one is the exact same interest rate you will pay on day 10,950. It doesn't matter if the economy booms, busts, or if inflation goes to the moon. Your principal and interest payment will never, ever change. It is a rock of stability in a sea of financial uncertainty. When you make a payment on a fixed-rate mortgage, that payment gets split into 4 pieces, often remembered by the acronym PITIP is for principal. That's the portion of your payment that actually pays down the money you borrowed. I is for interest, that's the profit the bank makes for lending you the money. T is for taxes, your property taxes, which the lender collects from you each month and holds in an account called escrow, paying the bill for you when it comes due. And the final I is for insurance, your homeowner's insurance, which is also typically paid from that same escrow account. The only parts of this payment that can change over 30 years are the taxes and insurance, which are set by your local government and insurance company, not the bank. But the core of your loan, the principal and interest, is set in stone. So why is this so incredibly popular? It boils down to a single powerful human emotion: the desire for certainty. With a fixed-rate mortgage, you can budget your life with incredible precision. You know exactly what your biggest monthly expense will be, not just next year, but in the year 2054. That predictability is a powerful psychological comfort. It feels like a financial security blanket. You're not just buying a house, you're buying peace of mind. You'll never have to lay awake at night worrying about what the Federal Reserve is going to do next. You'll never have to read a headline about rising interest rates and feel a knot of dread in your stomach. You have locked in your costs for housing for 3 decades. In a world that feels increasingly chaotic, that level of control is an intoxicating promise. It allows you to plan everything else, your retirement savings, your kids' college funds, your vacations, around this one immovable number. Sounds perfect, right? It's the ultimate set-it-and-forget-it financial product. But here's the question almost nobody asks. What are you paying for that peace of mind? Because it doesn't come for free. Lenders are not your friends. They are businesses, and they are masters of pricing risk. When they give you a 30-year fixed-rate loan, they are taking on a massive amount of risk themselves. They are betting that interest rates won't go up significantly over the next 30 years, because if they do, they'll be stuck with your low-rate loan on their books while they have to pay higher rates to their own depositors. To compensate for that 30-year risk they are taking on your behalf, they charge you a premium. That premium is baked directly into the interest rate they offer you. Think of it like this. A fixed-rate mortgage is an insurance policy against rising rates. And just like any insurance policy, you pay a premium for that protection, whether you end up using it or not. If rates do skyrocket and stay high for decades, you'll look like a genius. You've won the bet. But what if they don't? What if rates stay flat, or even go down? In that case, you've been paying a higher monthly payment month after month, year after year, for insurance you never needed. You're locked into your 7% rate, while new buyers are getting loans for 5%. Your only escape is to refinance, a process that is costly, time-consuming, and not guaranteed. And here is the critical piece of information that changes the entire equation. The average American homeowner stays in their home for about 9 to 13 years, and most refinance their mortgage every 7 to 10 years. So, millions of us are paying a 30-year premium for 30-year insurance on a loan we are statistically unlikely to keep for even half that long. We are paying for a marathon car rental when we only need the car for the weekend. This is the fundamental, hidden cost of the safe option. And it's the crack in the armor that opens the door for our other contender. The misunderstood, the feared, the modern adjustable rate mortgage. And what it is today is a completely different animal than the one that brought down the economy in 2008. We're about to break down exactly how it works, and why it might be the secret weapon you need to build wealth faster than you ever thought possible. So let's start by dissecting that beast from 2008. The mortgages that crashed the economy weren't just adjustable rate. They were a toxic cocktail of bad ideas. They were often interest-only, or even negative amortization loans, meaning your loan balance could actually go up every month. They were given to people with no income verification. These were the infamous ninja loans. No income, no job, no assets. And crucially, they lacked the safety features that are now legally required. Today's adjustable rate mortgage, or ARM, is a completely different creature, built with steel-reinforced guardrails. Think of it less like a ticking time bomb and more like a high-performance vehicle. It has more moving parts than a simple fixed-rate mortgage, but if you know how to drive it, it can get you to your destination of financial freedom much, much faster. So how does this machine actually work? Simpler than you think. An ARM is basically a hybrid loan. It starts its life as one thing and then transforms into another. It has two distinct phases. The first phase is the honeymoon period. This is a fixed-rate period where your interest rate is locked in and will not change, no matter what happens in the economy. This period is usually for 3, 5, 7, or even 10 years. This is where you see loans described as a 5/1 ARM or a 7/1 ARM. That first number tells you how many years your honeymoon lasts. A 5-to-1 ARM means your rate is fixed for the first 5 years. A 7/1 ARM, it's fixed for the first 7 years. Simple enough. During this honeymoon, your rate is almost always significantly lower than the rate on a standard 30-year fixed mortgage. And that difference is the magic ingredient. That's the fuel for the wealth-building engine we talked about. After the honeymoon is over, the loan enters its second phase, the adjustment period. This is the part that scares everyone. The second number in a 5-to-1 or 7-to-1 ARM tells you how often the rate can change. The 1 means the rate can adjust once per year for the rest of the loan's life. Now, this doesn't mean the bank's CEO just wakes up one morning and decides to double your interest rate. The rate isn't based on a whim. It's tied to a public, transparent financial benchmark called an index. The most common index used today is the SOFR, or the Secured Overnight Financing Rate. You don't need to be a Wall Street trader to understand this. Just think of the index as the wholesale cost of money. It's the baseline rate at which banks lend to each other. Your mortgage rate is just that wholesale cost, plus a markup for the bank. That markup is called the margin. The margin is a fixed percentage that the lender adds to the index. This is the bank's profit. The margin is set in stone when you sign your loan documents, and it never, ever changes for the life of your loan. So the formula is simple. Your interest rate equals the index plus the margin. If the SOFR index is at 4% and your margin is 2.5%, your new interest rate is 6.5%. If the index goes down, your rate goes down. If the index goes up, your rate goes up. It's transparent. You can look up the index value yourself anytime you want. But here's the most important part. This is the feature that makes today's ARMs fundamentally safe and completely different from their 2008 ancestors. They have safety valves built in called caps. Think of them as the guardrails on a winding mountain road. They prevent your mortgage payment from flying off a cliff. There are 3 types of caps you need to know. First is the initial adjustment cap. This limits how much your rate can increase the very first time it adjusts after your honeymoon period ends. A common initial cap is 2%, meaning if your starting rate was 5%, the highest it could possibly go in that first adjustment is 7%, even if the underlying index shot up by 10%. Second, there's the subsequent adjustment cap. This limits how much the rate can change in all the following years. This is also often capped at 2% per year. So your rate can never jump by more than a predictable, manageable amount in any given year. And the third and most critical is the lifetime cap. This is the absolute ceiling your interest rate can never, ever exceed, no matter what. A typical lifetime cap is 5% or 6% over your initial starting rate. So if you start with a 5% ARM, your rate can never, under any circumstances, go above 10% or 11% for the entire 30-year term of the loan. This creates a predictable worst-case scenario. You know the absolute maximum your payment could ever be from day one. There are no terrifying, unlimited surprises. The risk is defined, it's contained, and you can plan for it. Now let's get back to why this is a secret weapon. Let's use some real numbers. Imagine you're buying a home and need a $400,000 mortgage. The 30-year fixed rate is currently 7%. Your monthly principal and interest payment would be about $2,661. Now let's say you can get a 5-to-1 ARM with a starting rate of 5%. Your monthly payment is now just $2,147. That is a difference of $514 every single month. That's over $6,100 a year in cash flow that's back in your pocket instead of the bank's. For the first 5 years of that loan, you will save a grand total of $30,840 in interest payments. What could you do with an extra $30,000? You could annihilate your high-interest credit card debt. You could max out your retirement accounts. You could build an emergency fund that makes you sleep like a baby at night. Or you could invest it. If you took that extra $514 a month and invested it in a simple S&P 500 index fund, assuming an average historical return, that money could grow to over $36,000 in just those 5 years. You are literally using the bank's own money, at a discounted rate, to build your own wealth. You're playing offense. With a fixed-rate mortgage, you're always playing defense, just making the same payment month after month while inflation eats away at your savings. An ARM allows you to turn your biggest liability, your mortgage, into a tool for financial acceleration. But what about the fear? What happens after year 5 when the rate starts to adjust? Let's look at that worst-case scenario we talked about, using the caps. Your starting rate is 5%. Let's say in year 6, interest rates have gone crazy. The index has skyrocketed. Because of your 2% initial adjustment cap, your rate can only go up to a maximum of 7%. Guess what? That's the same rate you would have been paying from day one with the fixed-rate loan. So in the worst-case scenario, after 5 years of saving over $30,000, you end up with the same payment you would have had anyway. And what if rates stay the same or even go down? Then your rate stays low or gets even lower and you just keep saving money. And let's not forget the lifetime cap. If your lifetime cap is 6% over your starting rate of 5%, you know with 100% certainty that your rate will never go above 11%. You know your absolute maximum possible payment before you even sign the papers. This isn't a blind gamble. It's a calculated risk with a defined, limited downside and a massive potential upside. The question isn't whether an ARM is risky. The real question is, does the calculated risk of an ARM fit your specific financial situation and your plans for the future? Because for the right person in the right situation, it's not just a good option. It's the smartest financial decision they could possibly make. And figuring out if you are that right person is exactly what we're going to do next. We'll break down the specific types of homebuyers who can use an ARM to their massive advantage. So let's meet them. Let's meet the 4 types of people for whom an adjustable rate mortgage isn't just an option. It's a strategic financial weapon. First up, we have the planner. This is the person who has their life mapped out, at least for the next few years. Think of a medical resident who knows their residency is 4 years long, and then they're moving to another state to start their practice. Or a consultant on a 3-year contract in a new city. Or even a military family that knows they'll receive new orders in 5 years. For the planner, life isn't a question mark. It's a calendar. They know with near certainty that they will sell their home before the fixed-rate period on their arm ever expires. Let's make this real. Imagine a homebuyer named Sarah. She's taking a job in Austin, Texas, but she knows her company is expanding to Denver, and she's already been tapped to lead the new office there in 4 years. She's looking at a $500,000 house. She can get a 30-year fixed-rate mortgage at, let's say, 7%. Her monthly principal and interest payment would be about $3,326. Or she could get a 5-to-1 ARM. Because the bank has less long-term risk, they offer her a much lower introductory rate of 5.5%. Suddenly, her monthly payment drops to $2,838. That's a difference of $488 every single month. Over the 4 years she plans to live there, Sarah will save $23,424. That's a brand new car. That's a massive chunk of the down payment for her next house in Denver. For Sarah, the risk of the rate adjusting in year 6 is completely irrelevant. It's a ghost. It doesn't matter because she'll be long gone. She gets all the upside of the low introductory rate with virtually none of the downside. For the planner, an ARM is simply the cheaper, smarter way to borrow money for a predictable, limited time frame. Next, we have the climber. This is the classic first-time homebuyer. They aren't planning to move to a new city, but they are planning to move up the property ladder. They're buying a starter home, a smaller condo or a 2-bedroom house. They know it's not their forever home. It's their for right now home. Their plan is to live in it for 5 to 7 years, build some equity, save some money, and then sell it to buy a larger house when they start a family or get a big promotion. The climber's goal is different from the planner's. Their primary objective is to maximize savings for their next down payment. Let's look at Mark and Jen. They're buying their first townhouse. With a 7-to-1 ARM, they might save $300 or $400 a month compared to a 30-year fixed loan. They can take that extra cash and put it directly into a high-yield savings account earmarked for future dream home. Over 7 years, that's a potential savings of over $33,000, not including any interest they earn on it. When it's time to sell the townhouse and buy a bigger place, that $33,000 is a game changer. It could be the difference between a 15% and a 20% down payment on the next house, allowing them to avoid costly private mortgage insurance. For the climber, the ARM isn't just about a lower monthly payment. It's a strategic tool to accelerate their journey to their ultimate dream home. They're using the bank's money more cheaply for a set period to slingshot themselves into a better financial position for their next move. The third person who can win big with an ARM is the riser. This is someone who has a very high degree of confidence that their income is going to increase significantly in the near future. Think about a young lawyer who is on the partner track at their firm, or a tech salesperson who gets paid a modest base salary, but earns massive commissions that will likely grow each year. Or, the most classic example, a doctor just finishing their residency. Right now, as a resident, their income is relatively low. If they apply for a 30-year fixed mortgage, the bank will only qualify them for a certain loan amount based on that low income. It might not be enough to buy the house they want in the neighborhood they want to live in. But with a 5-to-1 ARM, the lower introductory rate means a lower monthly payment. Because the payment is lower, it fits more easily into the bank's debt-to-income calculations. This means the riser can often qualify for a larger loan and buy a better house today, instead of waiting 2 or 3 years. They are strategically taking on the risk of a future rate adjustment, because they know their financial picture will be radically different when that day comes. When the doctor's rate is set to adjust in 5 years, she won't be a resident anymore. She'll be an attending physician earning 3 or 4 times as much. A potential 2% rate hike that would feel catastrophic on her resident's salary will be a manageable minor annoyance on her new, much larger salary. The riser uses the ARM to buy the house they want for their future life, right now on today's income. It's a calculated risk, betting on their own career trajectory. And finally, we have the investor. This person isn't buying a home to live in. They're buying property as a business. For a real estate investor, especially one who plans to flip a house or hold it as a rental for only a few years, cash flow is king. Every single dollar of monthly expense eats into their profit margin. Let's say an investor buys a property to renovate and rent out. They choose a 5-to-1 ARM instead of a 30-year fixed loan. That lower payment in the first 5 years directly translates to higher monthly cash flow. That's more pure profit in their pocket every single month. This extra cash can be used for unexpected repairs, it can be reinvested into renovating the property to increase its value, or it can be saved up to form the down payment for their next investment property, allowing them to scale their portfolio faster. Furthermore, most savvy real estate investors don't hold on to a single property for 30 years. Their strategy often involves selling after a few years to realize the appreciation, and then using a 1031 exchange to roll those profits into a new, larger property. Just like the planner, they know they will likely sell the property long before the rate ever adjusts. For the investor, an ARM isn't an emotional decision. It's a cold, hard business calculation. It's a tool to minimize expenses and maximize returns in the short to medium term. So you have the planner, the climber, the riser, and the investor. These are the archetypes, the people who see an ARM not as a gamble, but as a calculated advantage. They are leveraging time and information to get a better deal. But hearing these success stories naturally leads to the terrifying question: what happens if they're wrong? What if the planner's job transfer gets delayed? What if the climber's starter home loses value and they can't sell? What if the riser gets laid off instead of promoted? What actually happens on that dreaded day when the rate finally adjusts? How high can it actually go? Is there any protection, any safety net built in? Or could your interest rate truly double overnight, as the horror stories suggest? Understanding the mechanics of that adjustment, and the hidden caps that control it, is the most crucial piece of this entire puzzle. And it's exactly where we're going next. So let's rip the Band-Aid off. The monster under the bed for every adjustable rate mortgage is that moment of adjustment. The day the music stops. To understand if that monster is real, you need to know that every single ARM in existence is built from 3 simple parts. Not 100, not 50, just 3. The index, the margin, and the caps. Once you understand these 3 components, the fear completely evaporates and is replaced by cold, hard math. It's like learning the 3 moves a magician uses to perform a trick. Once you see how it's done, you can't be fooled. First, let's talk about the index. The index is the part of your loan that moves. It's a benchmark interest rate that reflects the general conditions of the economy. Think of it like the wholesale price of money. Your lender doesn't set this rate. The market does. For decades, the most common index was called LIBOR, the London Interbank Offered Rate. But after a massive global scandal revealed that big banks were rigging those numbers, the world shifted to a more transparent and reliable index. Today, the most common one you'll see in the United States is called SOFR, the Secured Overnight Financing Rate. What SOFR is doing on any given day is completely out of your control, and it's out of your lender's control. It's a public number, you can Google it right now. It goes up when the Federal Reserve raises rates to fight inflation. It goes down when they cut rates to stimulate the economy. The index is the tide. And your ARM is a boat that is contractually obligated to float on that tide. That's it. It's the variable, the unpredictable element that makes an ARM. Now for the second piece, the margin. This is the simplest part of the entire equation. The margin is the lender's profit. It is a fixed percentage that is added on top of the index. If the index is the wholesale price of money, the margin is the lender's markup. It's how they keep the lights on. The most important thing to remember is that your margin is set in stone the day you sign your loan papers. It will never change for the entire 30-year life of your mortgage. If your margin is 2.75%, it will be 2.75% on day 1, and it will be 2.75% 29 years from now. It is the one constant in the ARM universe. So, how do these 2 pieces work together? It's simple addition. The formula is index plus margin equals your interest rate. This is called the fully indexed rate. Let's walk through it. Imagine your 5-to-1 ARM is about to adjust for the first time. You pull out your loan documents and see your margin is 2.5%. You then Google the current SOFR index and you see it's at 3%. Your new interest rate is simply 3%, the index, plus 2.5%, your fixed margin. Your new rate is 5.5%. If at the next adjustment a year later, the SOFR index has fallen to 1.5%, your new rate would become 1.5% plus your 2.5% margin, for a total of 4%. The math is that transparent. There's no secret formula, no backroom decision-making. It's public index plus fixed margin. But wait, what if the index skyrockets? What if the economy goes crazy and the SOFR index jumps to 8%? Does that mean your rate becomes 8% plus your 2.5% margin, for a total of 10.5% overnight? This is the core of the fear, and the answer unequivocally is no. And that brings us to the third and most important component of your ARM: the caps. The caps are your safety features. They are the contractual seatbelts and airbags built directly into your loan to protect you from a catastrophic financial crash. They limit how much your interest rate can change no matter what the index is doing. There are 3 caps you need to know, and they're usually written as a series of 3 numbers like 2/2/5 or 5/2/5. The first number is the initial adjustment cap. This governs the very first time your rate changes. So in our 2/2/5 example, the 2 means that at the first adjustment, your rate cannot increase by more than 2 percentage points above your original start rate. Let's say you got a fantastic introductory rate of 4%. When your 5-year fixed period is up, even if the math of index plus margin says your rate should be 9%, the initial cap slams on the brakes. The highest your rate can possibly go is 4% plus that 2% cap, for a new rate of 6%. The cap overrides the formula. It's your first and most powerful line of defense. The second number is the subsequent adjustment cap. This limits how much the rate can change at every following adjustment period, which is usually once per year. In a 2/2/5 ARM, that second 2 means that each year after that first adjustment, your rate can never go up or down by more than 2 percentage points from where it was the previous year. So if your rate adjusted to 6%, the absolute highest it could go the following year is 8%, even if the market index goes to the moon. It creates a predictable, step-by-step ceiling on any potential increases. And finally, the third number. This is the big one, the lifetime cap. This is the absolute, final unbreakable ceiling your interest rate can never, ever exceed for the entire life of the loan. In a 2/2/5 ARM, that 5 means your rate can never be more than 5 percentage points higher than your initial start rate. So if you started at 4%, come what may, hyperinflation, economic collapse, alien invasion, your mortgage interest rate will never, under any circumstances, go above 9%. That's 4% plus the 5% lifetime cap. This is the ultimate safety net. So let's go back to the horror story. Could your interest rate truly double overnight? Well, if your initial rate was 3% with a 2/2/5 cap structure, the highest it could go at the first adjustment is 5%. That's a significant jump, to be sure, but it is not doubling to 6%. And it certainly isn't going to 10% or 12% in a single leap, as the legends would have you believe. The system is designed with these governors, these limiters, to prevent that kind of shock. The truth is, many of those terrifying stories you've heard come from a bygone era of lending, before the 2008 financial crisis. Back then, you could find loans with no caps, or loans with tricky features like negative amortization, where your loan balance could actually go up even as you made payments. Those products were largely outlawed by the Dodd-Frank Act. The modern post-crisis ARM is a far more regulated and transparent financial tool. It's a different animal entirely. Understanding the structure, index, margin, and caps is the key. It transforms the ARM from a mysterious gamble into a calculated risk with clearly defined rules and a built-in safety net. You now know the absolute worst-case scenario before you ever sign the paperwork. You can look at the lifetime cap and ask yourself, can I afford my mortgage payment if my rate eventually hits this ceiling? If the answer is yes, you have quantified the risk. But this just tells us how the machine works. It doesn't tell us when to use it, or who should be using it. Knowing the mechanics is one thing. Knowing the strategy is something else entirely. Because under the right circumstances, for the right person, leveraging this machine isn't just about saving a few $100s a month at the beginning. It can be the strategic key that unlocks a property you couldn't otherwise afford, accelerates your wealth building, and gives you a critical financial edge. We've now dissected the engine of an ARM. In the next part, we're going to learn how to actually drive it. So you've been handed the keys to a high-performance vehicle. It's not your reliable, predictable family sedan. That's the fixed-rate mortgage. Gets you from A to B, no surprises. An adjustable-rate mortgage is different. It's a finely tuned machine, capable of incredible performance, but it demands a skilled driver. It demands a plan. Just grabbing the keys and hitting the gas without knowing how it handles in the rain is a recipe for disaster. This is the driver's manual. This is where we learn how to harness the power of an ARM, not just to get a house, but to execute a precise financial strategy that can put you years ahead of the game. Let's start with the most common and powerful strategy, the starter home slingshot. Meet Alex and Sarah. They're in their late 20s. Alex just finished his residency and is a new doctor, and Sarah is quickly moving up the ladder at a tech company. Their combined income is good now, but they know with near certainty it's going to be significantly higher in 3 to 5 years. They're tired of renting. They want to start building equity to have a place that's truly theirs. They've saved a down payment, but in their high cost of living area, the market is brutal. Let's run the numbers. With a 7% fixed-rate mortgage, the bank says they can qualify for a loan that gets them a $300,000 condo. It's okay, but it's small, and it's in a neighborhood they're not thrilled about. They feel stuck, defeated, but then their lender presents another option. A 5-to-1 ARM with an initial rate of just 5%. That 2% difference is seismic. Suddenly, their buying power explodes. At that 5% rate, they don't qualify for a $300,000 loan. They qualify for a $360,000 loan. That extra $60,000 isn't just a number. It's the difference between that cramped condo and a small single-family home. It's the difference between a neighborhood they'd settle for and one with great schools they'd be excited to live in for years. They're not blindly taking the lower payment. They are executing a plan. The plan is called the 5-year window. They know their ARM is fixed for the first 5 years. They also know that within those 5 years, Alex will become an attending physician, and Sarah is on track for a senior management role. Their income is projected to nearly double. Their strategy is to use the ARM as a bridge. It's a tool that allows them to get into the right house now, instead of waiting 2 or 3 more years while home prices continue to climb, potentially pricing them out of the market forever. Before the 5-year fixed period is up, they have 2 primary exit ramps. Option A: they sell the house. They've built equity, lived in a home they love, and with their higher incomes, they can now comfortably afford to upgrade. Option B: they refinance. If they love the home and want to stay, they'll take their much higher income and stronger financial profile and refinance the ARM into a stable, 30-year fixed-rate mortgage. They will have used the ARM to slingshot themselves onto the property ladder and into a better financial position. They looked at the lifetime cap on their ARM and ran a worst-case scenario. Even if the rate adjusted to its absolute maximum, their projected future income could still handle the payment. It would be tight, but it wouldn't bankrupt them. That is how you drive this machine. With foresight, a clear destination, and a planned exit. Next, let's look at a different kind of driver, one with a much clearer timeline. This is the short-term sure thing. Meet Dr. Chun. She's a brilliant cardiologist who has accepted a prestigious 4-year fellowship at a hospital in a new city. She knows with 100% certainty that when this fellowship is over, she is moving. She has no intention of staying in this city long-term. She looks at the rental market and it's insane. A decent apartment is going to cost her $3,000 a month. Over 4 years, that's $144,000 of rent gone forever. So Dr. Chun decides to buy a townhouse near the hospital. Why on earth would she lock in a 30-year fixed-rate mortgage? She'd be paying a premium for 30 years of rate stability that she absolutely does not need. It's like buying a lifetime warranty on a car. You know you're only going to own for 4 years. Instead, she gets a 5-to-1 ARM. She gets a significantly lower interest rate and a lower monthly payment than the 30-year fixed option. She'll save thousands of dollars in interest over those 4 years. Her plan is brutally simple. Live in the house, build some equity, and sell it before the first rate adjustment ever happens. The ARM structure perfectly aligns with her life's timeline. For her, the risk of the rate adjusting is virtually zero, because she'll be gone before it has the chance. She's not gambling. She's matching the right financial tool to a clearly defined job. Now let's shift gears to a more aggressive strategy, one for a more experienced driver. This is the rate drop strategist. This is for the financially savvy individual who understands market cycles and has a high tolerance for risk. Meet Mark. Mark works in finance. He watches the Federal Reserve, he analyzes economic data, and he has a strong opinion on where interest rates are headed. Let's say the current environment has high inflation, and 30-year fixed rates are hovering at a painful 7.5%. Mark believes this is a temporary peak. He believes that within the next 24 to 36 months, the economy will cool, and rates will come back down. Mark isn't going to lock in 7.5% for 30 years. He sees that as locking in a bad deal. Instead, he takes out a 5-to-1 ARM with an initial rate of 5.5%. Right away, he's saving a massive amount of money on his monthly payment. But he's not just spending that savings. He's a strategist. He uses that extra cash flow to build a bigger emergency fund and aggressively invest in the market. He is betting on himself and his analysis. His plan is an active one. He is constantly watching interest rate trends. The moment fixed rates drop to a level he's comfortable with, say 5.75% or 6%, he will pounce. He will refinance his ARM into a new 30-year fixed-rate loan, locking in that new, lower rate for the long haul. He used the ARM as a temporary vehicle to navigate a high-rate environment, saving money all along the way, with the explicit goal of jumping into a better long-term vehicle when the opportunity arose. But what if he's wrong? What if rates don't drop? What if they go up? This is why this strategy is not for everyone. Mark knows the risks. He has a substantial income and a massive cash cushion. He has calculated his worst-case scenario based on his ARM's caps. If his bet fails and his rate adjusts upward in 5 years, the payment will be uncomfortable, but it will not destroy him financially. He has the shock absorbers to handle the bumpy road. He is making a calculated risk, not a blind gamble. 3 different people, 3 different life situations, 3 brilliant ARM strategies. Alex and Sarah used it as a slingshot to get into a better home sooner. Dr. Chun used it as a perfectly sized tool for a short-term need. And Mark used it as a sophisticated instrument to play the interest rate market. The common thread isn't the loan itself. It's the person holding it. In every case, the ARM was not the destination. It was the vehicle. And every single driver had a clear map, a planned route, and a predetermined exit strategy before they ever turned the key. We've just met the master drivers. They understood the road, they checked the weather, and they had a map to their destination. But what happens when the road suddenly disappears? When a fog of economic uncertainty rolls in, and the engine starts to sputter? We've seen how to drive an ARM correctly. But the most important lesson any driver can learn is how to recognize a crash waiting to happen. Because for every success story, there's a cautionary tale. A story of someone who got the timing wrong, ignored the warning signs, and found themselves trapped in a financial nightmare. In the next part, we're going to explore those exact scenarios. We'll uncover the Armageddon situations, the perfect storms that turned the American dream into a financial catastrophe for millions, and how you can ensure you are never one of them. To understand the risk, we have to travel back in time. Not that long ago, really. To the mid-2000s, the air was thick with optimism. House prices weren't just rising, they were skyrocketing. It felt like a law of nature, like gravity, but in reverse. Flipping houses was a national pastime, and getting a mortgage was easier than ordering a pizza. Lenders were practically throwing money at people. And in this frenzy, the adjustable rate mortgage wasn't just an option. It was the golden ticket. Let's imagine a family. We'll call them the Bakers. A teacher and a plumber, 2 kids, living in a cramped apartment. They did everything right. They saved, they worked hard, but the housing market was running away from them. Every time they saved another $10,000, the price of a starter home in their neighborhood jumped by $20,000. They were watching their dream of a backyard for their kids fade into an impossible fantasy. Then they walk into a mortgage broker's office. The broker runs the numbers on a 30-year fixed-rate mortgage. The monthly payment is crushing. It's more than their rent, more than they can comfortably afford. You can see the hope drain from their faces. But then the broker smiles and says, "Don't worry, I've got something special for you." He slides another piece of paper across the desk. It's an ARM, a 2/28 ARM to be exact. He explains it like this. For the first 2 years, your interest rate is locked in at an incredibly low 2.5%. Your monthly payment will be $1,000 less than that fixed-rate loan. It's a piece of cake. The Bakers look at each other. $1,000 a month? That's life-changing. That's the difference between scraping by and actually living. They could finally afford the house with the little yard in the good school district. They ask the obvious question. But what happens after 2 years? The broker waves his hand dismissively. "Oh, don't worry about that. The rate adjusts, sure, but house prices are going up so fast you'll have a ton of equity. In 2 years, you just refinance into another low-rate loan. Everybody does it. It's a no-brainer." It was a siren song, and millions of families just like the Bakers sailed towards it. They weren't financially illiterate. They weren't greedy gamblers. They were just regular people, desperate to grab a piece of the American dream before it floated away for good. They were sold a story that the party would never end. So the Bakers sign the papers. They move into their new home. The first 2 years are bliss. It's everything they dreamed of. They host barbecues in the backyard. Their kids are making friends. They're making their mortgage payments on time every time. They feel smart. They feel successful. They beat the system. And then a thick envelope arrives in the mail. It doesn't look like junk mail. It's from their mortgage servicer. Inside is a letter filled with financial jargon, but two things stand out: interest rate reset notification and a new monthly payment amount. The Bakers stare at the number in disbelief. It can't be right. It's a typo. Their payment, the one that was so easy to make, hasn't just gone up a little. It has nearly doubled. What happened? Well, while the Bakers were enjoying their new home, the world outside had changed. The Federal Reserve, worried about the overheated economy and rising inflation, had been steadily increasing interest rates. The index their arm was tied to, the benchmark used to calculate their new rate, had shot up. Their new rate wasn't the teaser 2.5% anymore. It was the index, which was now at 5%, plus their lender's margin of 3%. Their new interest rate was 8%. Let's do the math they were now forced to do at their kitchen table in a panic. On their $350,000 loan, the initial payment at 2.5% was about $1,383 a month for principal and interest. Manageable. At the new 8% rate, their payment exploded to $2,568 a month, an increase of nearly $1,200 every single month. Their budget wasn't just broken, it was shattered. The extra $1,000 they thought they were saving was a phantom. It was a debt that had been quietly accumulating, and the bill was now due. But what about the broker's advice? Just refinance. The Bakers frantically call him, then other lenders. The answer is always the same. We're sorry, we can't help you. Why? Because the music had stopped. The housing bubble had burst. The very force that was supposed to save them, skyrocketing home values, had reversed with catastrophic speed. Their house, which they bought for $375,000, was now only worth $250,000. They owed $350,000 on a house worth $100,000 less. They were underwater. No bank on earth would give them a new loan to pay off an old, larger loan. The escape hatch was welded shut. Okay, so they can't refinance. What about selling? That was even worse. If they sold the house for its market price of $250,000, they would have to show up at the closing with a check for $100,000 just to pay off the bank. They didn't have $100,000. They didn't even have $5,000. This was the perfect storm. A payment shock they couldn't possibly afford, combined with a housing crash that trapped them in the home. Their home was no longer a dream. It was a prison. It was a financial anchor dragging their family to the bottom of the ocean. The Bakers did what millions of others did. They tried to hold on. They drained their meager savings. They ran up their credit cards to buy groceries. They stopped answering the phone because it was always a collector from the bank. The stress was unbearable. The arguments, the fear, the shame. Eventually, the foreclosure notice was taped to their front door. They had to pack up their lives, explain to their confused children why they had to leave their home, and watch as their biggest investment, their piece of the American dream, was sold on the courthouse steps. This wasn't an isolated story. This was the story of an entire generation of homeowners. This was the Armageddon. These predatory, poorly understood loans, built on a foundation of lies and wishful thinking, were the detonators for the 2008 global financial crisis. They created a tidal wave of foreclosures that tanked the market, destroyed trillions in wealth, and cost millions of people their jobs. This is the ghost that haunts the adjustable rate mortgage. It's the reason your parents, your friends, maybe even your financial advisor, will tell you to run in the other direction. The trauma from that crisis is deeply embedded in our financial DNA. The very name, adjustable rate mortgage, became synonymous with ruin, foreclosure, and financial catastrophe. But here's the critical thing you need to understand. The arms that exist today are not the same ticking time bombs that blew up the economy in 2008. The entire landscape has changed. The government stepped in with massive regulations to outlaw those toxic features and protect consumers. The wild, anything-goes lending of the 2000s is gone. So, while the story of the Bakers is a vital cautionary tale, it's not the end of the story. The arm has evolved. It's a different financial tool now, with different safeguards and different rules. And for the right person in the right situation, it can still be an incredibly powerful and intelligent choice. The question is, are you that person? And what exactly makes today's arms so different? To understand that, we have to dissect the very anatomy of a modern adjustable rate mortgage. because the arm that exists today is a fundamentally different creature from the one that roamed wild before 2008. The old arms were like experimental aircraft built in a backyard shed. Some flew, but many were designed to fail. Today's arms, thanks to a mountain of post-crisis regulation like the Dodd-Frank Act, are more like commercial airliners. They are built with redundancies, safety checks, and fail-safes designed to protect the passenger. That's you, not just the airline. So let's pop the hood on the most common type of arm you'll see today, the 5-1 arm. You might also see a 7-1 or a 10-1, but the logic is exactly the same. That name, 5 of 1, isn't just a random set of numbers. It's a code. It's the blueprint for how your mortgage will behave over its entire life. The first number, the 5, represents the single most important feature of a modern arm, the initial fixed rate period. For the first 5 years of your loan, your adjustable rate mortgage doesn't adjust at all. It's a wolf in sheep's clothing, or rather, a sheep in sheep's clothing for a while. Your interest rate is locked in, solid as a rock, for 60 straight months. It behaves exactly, and I mean exactly, like a fixed rate mortgage. Your payment is the same every single month. No surprises, no drama. This period is designed to give you stability and predictability right after you buy your home, which is often when your finances are the tightest. Now the second number, the 1, tells you what happens after those first 5 years are up. This is the adjustment period. The 1 means that once the fixed period is over, your interest rate has the potential to change once per year for the remaining life of the loan. If it were a 5-6 arm, it would adjust every 6 months. A 7-1 arm means a 7-year fixed period, then adjustments once per year. Simple enough, right? The initial period gives you a long runway of stability, and the adjustment period dictates the frequency of change afterward. But this is where the fear creeps in. If the rate can change, what stops it from skyrocketing to 20% overnight? This is the core question, and the answer reveals the biggest difference between the old, dangerous arms and the new, regulated ones. The answer is a system of safety nets called caps. But before we get to the caps, we need to understand what your new rate is even based on. Lenders can't just wake up and decide to double your interest rate because they feel like it. The new rate is tied to a specific, publicly available financial benchmark called an index. Think of the index as the wholesale cost of money in the economy. The most common index used today is called the SOFR, the Secured Overnight Financing Rate. It's a broad, transparent measure of borrowing costs, published every single day by the Federal Reserve Bank of New York. It goes up when the economy is hot and the Fed is raising rates. It goes down when the economy is cool and the Fed is cutting rates. Your mortgage rate is simply following a public, verifiable economic trend. The lender doesn't just give you the index rate, though. They add their profit on top of it. This is called the margin. The margin is a fixed percentage that is set in stone in your loan documents on day 1. It never ever changes for the entire life of your loan. So the formula is simple. Index plus margin equals your new interest rate. Let's use an analogy. Imagine you're buying bread from a baker. The index is the market price of flour, which can change daily. The margin is the baker's fee for his time and skill to bake the loaf. That fee is, say, $2, and it never changes. So, if flour costs $3 one day, your loaf of bread is $5. If flour drops to $1, your loaf is $3. The baker's profit is always the same. The only thing that changes is the underlying cost of the raw ingredient. That's exactly how your arm works. The margin is the bank's fixed profit. The index is the fluctuating cost of the raw ingredient. Money. This transparency is key. You can look up the SOFR index yourself and know exactly where your rate is headed. But even with that transparency, what if the index, the price of flour, goes crazy? What if it shoots up dramatically? This is where we get to the most important part of a modern arm. The life rafts. The circuit breakers. The caps. A modern arm doesn't just have one cap. It has 3, creating a triple lock box of protection around your interest rate. These are typically expressed as a series of 3 numbers, like 2/2/5. Let's break down what that means. The first number is the initial adjustment cap. In our 2/2/5 example, it's a 2. This means that at the very first adjustment, after your 5-year fixed period ends, your interest rate cannot increase by more than 2 percentage points, no matter what the index has done. So if your initial rate was 5%, the absolute highest your rate could go in year 6 is 7%. Even if the index has shot up by 4 or 5 points, it doesn't matter. You are protected by that initial cap. It's a shock absorber for that first big change. The second number is the subsequent adjustment cap. This is also a 2 in our example. This governs all the adjustments after the first one. It means that in any following year, year 7, year 8, year 9, and so on, your rate can never increase by more than 2 percentage points from where it was the year before. So if your rate adjusted to 7% in year 6, the highest it could possibly go in year 7 is 9%. This prevents a slow, creeping series of massive hikes. It ensures any increases are gradual and predictable. You'll never see your rate jump by 5 or 6% in a single year. The system has breaks. And finally, the most important number of all, the third one. In our example 2/2/5, it's the 5. This is the lifetime cap. This is the ultimate safety net. It dictates the absolute maximum your interest rate can ever increase over the entire 30-year life of the loan, relative to your starting rate. In this case, it's 5 percentage points. So, if you started with a 5% interest rate, no matter what happens in the world, no matter what the index does, no matter how many years pass, your interest rate can never ever go above 10%. It has a ceiling, a hard stop. This is the feature that was often missing or criminally high in the pre-2008 era. Today, it's a non-negotiable, government-mandated safety feature. So let's put it all together. You get a 5-to-1 arm with a starting rate of 5% and caps of 2/2/5. For the first 5 years, you pay exactly 5%. In year 6, your rate can go up but no higher than 7%. In year 7, it can go up again but no higher than 9%. And for the entire rest of the loan, it can never ever exceed 10%. And remember, these are all worst-case scenarios. If the index goes down, your interest rate goes down with it. The caps only limit how high the rate can go, not how low. This structure transforms the arm from a gamble into a calculated tool. It's no longer a blind bet on the future of interest rates. It's a hybrid product that gives you a guaranteed period of stability, followed by a period of managed, predictable flexibility with multiple, robust safety nets. You know the rules of the game from the very beginning. You know your worst-case payment in year 6. You know your worst-case payment for the life of the loan. The terrifying uncertainty of the old arms has been replaced by structured, regulated predictability. The question then is no longer, is an arm a ticking time bomb? The real question is, does my personal financial situation and my timeline for this house align with the structure of this powerful, but specific, financial tool? Because for some people, the answer is a resounding yes. So, who are these people, the ones who look at an arm not as a risk but as an opportunity? Let's meet them. Because their stories, their specific situations, are the key to understanding the true power of an adjustable rate mortgage. First up, let's talk about the short-termers. Picture a young couple, we'll call them Mark and Jessica. They're in their late 20s, living in a booming tech hub. They've got great jobs, but they're tired of paying sky-high rent. They want to buy a condo, start building equity, and have a place to call their own. But here's the crucial detail. They know with near certainty that they will not be in this city, let alone this condo, in 10 years. Mark's company has a clear track for a promotion that involves relocating to headquarters in about 6 years. They plan on starting a family in a few years and will need more space. Their current life has a built-in expiration date. They go to a lender and get 2 options for their $400,000 loan. The first is a 30-year fixed rate at 7%. The monthly principal and interest payment is about $2,660. The second option is a 7-to-1 arm with an initial rate of 5.5%. The monthly payment on that is $2,270. That's a difference of $390 a month. Now, $390 might not sound like a world-changing amount, but let's do the math. Over the first year, they save over $4,600. Over the 7 years of their fixed-rate period, they will have saved $32,760. That is a serious amount of money. That's a brand new car. That's the seed money for their future child's college fund. It's a significant financial cushion for their cross-country move. And the biggest risk of the arm, the rate adjustment, is completely irrelevant to them. Why? Because they plan to sell the condo in year 6, a full 12 months before the rate could ever change. For Mark and Jessica, choosing the 30-year fixed-rate mortgage would be like paying a massive insurance premium for a risk that doesn't exist for them. They are literally paying extra every single month for 30 years of stability when they only need 6. The arm isn't a gamble. It's a tailored suit. Fits their life plan perfectly. Next, let's meet the career climber. This is Dr. Anya Sharma. She just finished her grueling medical residency and has accepted a position at a prestigious hospital. Her starting salary is good. But it's nothing compared to what she'll be making in 5 to 7 years once she becomes a partner in her practice. Her income trajectory isn't just a hope, it's a well-established path in her profession. She wants to buy a home near the hospital now to settle in and stop moving around. But with her current student loan burden and starting salary, the payment on a 30-year fixed loan for the house she wants is tight. It's doable, but it would leave her with very little disposable income for savings, emergencies, or just enjoying her life after a decade of intense training. She opts for a 10-to-1 ARM. Her initial rate is significantly lower than the fixed-rate option, freeing up nearly $600 a month in cash flow. This isn't just fun money. This is money she can use to aggressively pay down her highest-interest student loans, max out her retirement accounts, and build a robust emergency fund. She is using the ARM as a strategic tool to fortify her entire financial foundation during her lower earning years. She knows that in 10 years, when her rate is scheduled for its first adjustment, her income will have likely doubled. A potential increase in her mortgage payment that might seem terrifying today will be a manageable, predictable expense by then. She's trading a small amount of long-term uncertainty for a massive amount of immediate financial power and flexibility. She's leveraging her own future, betting on her own career path, and the ARM is the vehicle that allows her to do it. And now for our third profile, the one that requires the most financial savvy and stomach for risk, the rate strategist. This is someone buying a home in a high-interest rate environment. Let's say 30-year fixed rates are hovering around 7.5%. Everyone is complaining about how expensive it is to borrow money. The rate strategist sees this differently. They believe, based on economic forecasts and historical cycles, that rates are unlikely to stay this high for the long term. They anticipate that within the next 3 to 5 years, rates will likely come down. So what do? They could take out a 30-year fixed mortgage at 7.5%, telling themselves they'll just refinance when rates drop. And that's a valid plan. But refinancing isn't free. Comes with thousands of dollars in closing costs. Instead, the rate strategist takes out a 5-to-1 ARM at 6%. From day one, they are paying a significantly lower rate than the rest of the market. They are saving hundreds, maybe thousands of dollars every month. Their plan is to enjoy these savings for a few years, and then once interest rates fall to, say, 5%, they will refinance their ARM into a new 30-year fixed-rate mortgage at that lower rate. Essentially, the ARM acts as a bridge. It's a temporary, lower-cost way to get into the home they want, while they wait for more favorable long-term financing conditions. This is an active strategy. It's a calculated bet, and it carries a real risk. What if rates don't go down? What if they go up? This is where the rate caps we discussed become so incredibly important. The rate strategist needs to look at the lifetime cap on their ARM and ask a critical question. If my bet is wrong and my rate adjusts to the absolute maximum allowed, can I still afford this payment? If the answer is no, this strategy is too risky. But if the worst-case scenario is still within their financial capacity, then the potential reward, years of significant savings, might be well worth the calculated risk. For all three of these profiles, the short-termer, the career climber, and the rate strategist, the adjustable rate mortgage isn't a ticking time bomb. It's a precision instrument. It's a financial tool that acknowledges a fundamental truth. Life is not static. People move, incomes grow, and economic conditions change. A mortgage that can adapt to those changes can be incredibly powerful for the right person at the right time. It's about aligning the structure of your debt with the trajectory of your life. The question isn't whether an ARM is good or bad. The question is, does your life's blueprint call for flexibility or for unwavering stability? Because while an ARM is the perfect solution for Mark, Jessica, and Anya, there is a massive group of people for whom the answer is the polar opposite. People for whom predictability isn't just a feature, it's the entire point. And for them, the simple, steadfast, and sometimes boring 30-year fixed-rate mortgage isn't just a good option. It's the only one that lets them sleep at night. But what if there's a third way? A middle ground between the ironclad certainty of a 30-year fixed and the wild frontier of a fully adjustable rate? For a huge number of homebuyers, this middle ground isn't just an option. It's the secret weapon. This is the world of the hybrid ARM. The 5/1, the 7/1, the 10/1. These aren't just random numbers, they are a strategic choice. And understanding them can be the difference between a good decision and a brilliant one. Think of it like this. A 30-year fixed-rate mortgage is a marriage. You commit for the long haul through thick and thin, for better or worse, till the loan is paid in full. An adjustable rate mortgage can feel more like unpredictable dating. But a hybrid ARM? That's like a long-term lease on a fantastic interest rate. You get a guaranteed, fixed, often significantly lower rate for a set number of years, 5, 7, or 10. That first number is your honeymoon period. It's your island of stability in a sea of economic change. During those years, your payment is as predictable as the sunrise. It behaves exactly like a fixed-rate mortgage, just with a better rate. After that initial period is over, after the 5, 7, or 10 years are up, the one in May 1st or July 1st kicks in. This means the rate will then adjust once every 1 year for the remaining life of the loan, based on the market index it's tied to. You get the best of both worlds. The low payment and savings of an ARM upfront, combined with a long runway of predictability before any changes happen. So who is this for? Who is the ideal candidate for this have your cake and eat it too loan? Well, it's not for the person who plans to live in their house for 30 years and pass it down to their kids. It's for the person who has a plan. It's for the planner, the strategist, the person who doesn't see their life in 30-year chunks, but in 5 to 10-year chapters. Consider a military family. They know they're getting reassigned in 4 years. Why would they pay a premium for 30 years of rate security when they only need 4? A 5/1 ARM is practically custom-built for them. They get the absolute lowest possible payment for the entire time they own the home, maximizing their cash flow and savings, and then they sell the house and move on long before that first rate adjustment ever hits. For them, the adjustable part of the loan is completely irrelevant. They're playing a different game and they're winning. Or think about the young doctor, just finishing her residency. She's buying her first condo, but her income is still relatively low. She knows with near certainty that in 3 years she'll become an attending physician, and her salary will triple. A 5/1 or 7/1 ARM allows her to afford a home now, with a manageable payment. By the time the rate is scheduled to adjust, her financial picture will be completely transformed. That potential payment increase that looks terrifying today will be a minor blip on her radar in 7 years. She's betting on her own future, and it's one of the safest bets she can make. This strategy is for anyone with a clear, foreseeable exit plan. Maybe you're a young couple buying a starter home, and you know you'll need more space once you have kids in 5 or 6 years. Maybe you're a software engineer who just joined a startup, and your stock options are set to vest in 4 years, giving you a massive cash windfall you can use to pay down the mortgage or move. In all these cases, the question isn't, can I afford the payment if it adjusts to the maximum? The real question is, will I even still have this loan when the fixed period is over? If the answer is a confident no, then paying extra for a 30-year fixed rate is like buying a 30-year warranty on a car you plan to sell in 5. It's paying for protection you will never use. But this brings us to a much riskier, much more aggressive strategy. It's a high-wire act that millions of Americans perform every year. It's the strategy of taking out a hybrid ARM with no intention of moving, but with the full intention of refinancing before the fixed period ends. This is the refinancing gambit. The logic is seductive. You take a 7/1 ARM instead of a 30-year fixed. You save, let's say, a full percentage point on your interest rate. On a $400,000 loan, that's over $250 a month in savings. That's $3,000 a year, or $21,000 over the 7-year fixed period. The plan is simple. Enjoy those massive savings for 7 years, and then sometime before that first adjustment hits, refinance the remaining balance into a new, stable, 30-year fixed-rate loan. You get the benefit of the low payment now, and the security of a fixed rate later. Sounds like a perfect plan. A loophole. A way to game the system. But it's a bet. And you're not just betting on one thing, you're betting on 4. For this strategy to work, for critical things have to go right. First, you're betting on interest rates. You are fundamentally making a wager that in 7 years, interest rates will be at a level you find acceptable. What if you're wrong? What if rates have skyrocketed? You could find yourself refinancing into a fixed rate that's dramatically higher than the one you could have gotten today, wiping out all your initial savings and then some. Or worse, rates could be so high that you're forced to let your ARM start adjusting, facing that payment shock you were so sure you could avoid. Second, you're betting on your financial life. To refinance, you have to requalify for a mortgage all over again. The bank will scrutinize your income, your job stability, and your debt. What if, in 7 years, you've changed careers and your income is lower? What if you've been laid off? What if you've taken on a large car loan or have significant credit card debt? Any of these things could make you ineligible for a refinance, trapping you in your adjustable rate loan just as it's about to become more expensive. Third, you're betting on your credit score. A pristine credit score is your ticket to the best interest rates. But life happens. A missed payment, a medical bill that goes to collections, a financial dispute. Any number of things can damage your credit over a 7-year period. If your score drops significantly, you might only qualify for a new loan at a terrible rate, or you might not qualify at all. And finally, the fourth and perhaps most dangerous bet. You are betting on the value of your home. To refinance, the bank will order a new appraisal. If your home's value has stayed the same or gone up, you're fine. But what if the market has turned? What if your home is now worth less than what you owe on it? This is called being underwater, and it is the refinancing kryptonite. No bank will give you a new loan for more than your house is worth. If you're underwater, you are stuck. Period. There is no escape hatch. You either sell the house at a massive loss or you ride out the adjustable rate, no matter how high it goes. This 4-part gamble, on rates, on your income, on your credit, and on your home's value, is precisely what led to the catastrophic foreclosure crisis in 2008. Millions of people took out arms with low teaser rates, assuming they could always refinance. They were told home values only go up. They were told jobs were secure. They were wrong. When the housing market crashed and the economy soured, their escape route vanished overnight. They were trapped. Now, it's crucial to understand that the mortgage industry has changed. The laws are stricter. Lenders are now required to qualify you based on your ability to repay the loan even at a higher, adjusted rate. This protects the bank, but it doesn't necessarily protect you from the pain of a much higher payment. The fundamental personal risks of the refinancing gambit haven't changed at all. You are still juggling 4 balls in the air, and if any one of them drops, the whole plan falls apart. So the decision to take an arm, whether it's a hybrid or not, isn't just a financial calculation. It's a risk assessment. It forces you to ask some very deep and honest questions. How certain are you about your 5-year plan? How stable is your industry? How disciplined are you with your finances? How much risk, real risk, are you truly willing to take on in exchange for a lower payment today? Because we've now broken down the mechanics, the strategies, and the cautionary tales. We've looked at the numbers. But the final, most important piece of this entire puzzle has nothing to do with math. It's about psychology. It's about understanding your own unique tolerance for risk and what price you're willing to pay for peace of mind. This is where the entire decision hinges. It's a gut check. It's about asking yourself a simple but profound question. Are you a sleeper, or are you a strategist? Let me explain. The sleeper is someone whose highest financial priority is predictability. They want to know with absolute ironclad certainty what their largest monthly bill will be, not just next month, but next decade. In the year 2045, they want to know that their principal and interest payment will be the exact same number it is today. This certainty is a non-negotiable part of their financial well-being. The thought of a fluctuating mortgage payment, one that could be swayed by a press conference from the Federal Reserve or economic turmoil on the other side of the world, is the stuff of nightmares. It introduces a variable they cannot control into the most fundamental part of their budget. For the sleeper, a fixed-rate mortgage isn't just a loan product, it's a sleep-at-night insurance policy. They are consciously and willingly paying a small premium, that slightly higher interest rate we talked about, for 360 consecutive months of peace of mind. They are buying their way out of ever having to watch the financial news with a knot in their stomach. They are purchasing the freedom to set their budget in stone and focus their mental energy on other things. Their career, their family, their investments. They know they might be leaving some money on the table if rates were to fall. They know they might be paying a little more than their neighbor who took a risk. And they are perfectly, completely okay with that. The price of certainty is a price they are happy to pay. If this sounds like you, if the very idea of your housing payment increasing by hundreds of dollars a month makes you feel physically ill, then your choice is already clear. You are buying stability. You are a sleeper, and the fixed-rate mortgage was designed for you. But then there's the strategist. The strategist looks at the world differently. They see numbers not as threats, but as opportunities. They understand that risk and reward are two sides of the same coin. The strategist hears adjustable rate mortgage and doesn't immediately think of a worst-case scenario. Instead, they think of the initial lower interest rate as a strategic advantage, a tool to be wielded. They see that discount as cash flow they can use for the first 3, 5, or 7 years. Money that isn't going to the bank in interest is money they can use to aggressively pay down their principal, reducing the loan balance so that if and when the rate does adjust, it's adjusting on a smaller number. Or it's money they can divert into other, higher return investments. They are comfortable with the calculated risk. But here is the critical distinction. The strategist is not a gambler. A gambler walks into a casino and hopes for the best. A strategist walks into a complex situation having already calculated the odds, and most importantly, having a plan for every likely outcome. The strategist has read the fine print on the arm. They know their lifetime cap. They've run the numbers and said, okay, in the absolute worst-case scenario, my payment could rise to X. Can I afford that? Yes. Would I like it? No. But it won't break me. The strategist has a robust emergency fund, not just for a broken water heater, but for a broken interest rate environment. They have a cash cushion specifically to absorb the shock of a higher payment. Furthermore, the strategist often has a clear timeline. They might be a young doctor in residency who knows their income is set to triple in 4 years, well before their 5-to-1 arm is scheduled to adjust. They can easily absorb a higher payment later. Or they might be a family that knows they are moving for work in 6 years. They don't care what the rate does in year 8 because they'll be long gone. For them, a 30-year fixed rate is illogical. Why pay a premium for 30 years of stability when you only need 7? They are using the 7/1 arm for its intended purpose, as a short to medium-term financing tool to minimize costs over a specific known period. So you have to ask yourself, which one are you? There is no right or wrong answer. It's about self-awareness. Let's make it real. Imagine 2 scenarios. In scenario 1, it's 5 years into your mortgage. You turn on the news, and the anchor is talking about runaway inflation and emergency rate hikes by the federal. If your first immediate visceral reaction is a wave of panic, a cold sweat, the urge to check your mortgage statement even though you know it hasn't changed yet, you're probably a sleeper. The emotional cost of that anxiety is simply not worth the potential savings of an arm. Your peace of mind has a price, and you should pay it with a fixed-rate loan. In scenario 2, you hear that same news report, but your reaction is different. You think, okay, I knew this was a possibility. Let me check my spreadsheet. My rate adjusts in 2 years. My income has gone up 15% since I bought the house, and I've been making an extra payment every quarter. My cash reserve is fully funded. Worst case, I'll have to cut back on my vacation budget for a year or 2. Or maybe this is the trigger to refinance. I have options. If that's your internal monologue, if you see it as a problem to be managed rather than a catastrophe to be feared, then you have the mindset of a strategist. An adjustable rate mortgage could be a powerful tool in your financial arsenal. This decision is about so much more than the difference between 6.5% and 7%. It's about the kind of life you want to lead in your new home. Do you want to lock the door at night and never have to think about the mechanics of your mortgage again? Or do you want to be an active participant, constantly optimizing and adjusting your strategy to get the best possible financial outcome, accepting the risks that come with it? The American dream of homeownership is powerful, but that dream can curdle into a nightmare if the financial structure supporting it is at odds with your own personality. A house is supposed to be a source of comfort and security, not a source of constant low-grade anxiety. If you take an arm because a spreadsheet told you it was cheaper, but you spend the next 7 years dreading the adjustment date, you haven't saved money. You've just traded it for years of stress. You've made a financially logical but emotionally bankrupt decision. Conversely, if you're a strategist at heart, with a strong income, a clear plan, and a healthy appetite for calculated risk, taking a fixed-rate mortgage could feel like a cage. You might spend years feeling frustrated that you're overpaying, that you left a strategic advantage on the table because of an irrational fear. So, here is the final takeaway, the one thing to remember from this entire series. The best mortgage for you is not the one your lender recommends, or the one your parents had, or the one that has the lowest possible number on paper. The best mortgage is the one that lets you sleep at night. It's the one that aligns with your personal tolerance for risk, your financial discipline, and your plans for the future. The choice between a fixed and an adjustable rate mortgage is one of the biggest financial decisions you will ever make. But it's also one of the most personal. It's a reflection of who you are. So look past the numbers, look past the headlines, and look inward. Understand your own psychology. Are you building a fortress with predictable walls? Or are you piloting a nimble ship, ready to adjust course to catch the most favorable winds? Once you answer that question, your choice of mortgage won't just be a financial transaction. It will be the foundation upon which you build your life in that home. A foundation built either on unshakable stability or on strategic flexibility. The choice is yours. Now you have the framework to make it wisely.